Hey there, today we're going to dive into a concept called intrinsic value, in which you learn to unlock the secret to figuring out how much a company's stock is really worth. So we'll break it down step by step and even use a real-world example with everyone's favorite soda company, Coca-Cola. So what is basically an intrinsic value? Intrinsic value is the true worth of a stock based on its underlying assets, earnings potential, and future cash flows. It represents what a stock is truly worth, independent of its current market price. Now get into the example of Coca-Cola in which we calculate the intrinsic value of a stock. Step number 1. Project future cash flows. Imagine you're predicting how much allowance you'll get over the next 5 years. For Coca-Cola, as an example, we estimate their future cash flows to be: for year 1, $10 billion. For year 2, $10.5 billion. For year 3, $11 billion. For year 4, $11.5 billion. For year 5, $12 billion. Step number 2, estimate perpetual growth rate. After those 5 years, companies still grow, but at a slower rate. We'll assume a conservative 2% growth rate for Coca-Cola. Step number 3, choose a discount rate. In our example, we're using a discount rate of 7%. This means for every year that passes, we make the future money a bit smaller by 7%. The money we get in the future isn't as valuable as money we have right now. This is because now we can use money to buy things or invest it, and earn more money over time. It's a way of making sure we're being fair about how much money is worth when it's not right in our hands. So the discount rate is like a time-traveling tool that helps us compare future money with today's money and think about any uncertainties. Step number 4, calculate present value of cash flows. Now we shrink the future money using the discount rate. The formula is present value equals future cash flow divided by 1 plus discount rate powers number of years. For year 1, it's 10 billion divides by 1.07 powers 1 equals $9.35 billion. For year 2, it's 10.5 billion divides by 1.07 powers 2 equals $8.73 billion. For year 3, it's 11 billion divides by 1.07 powers 3 equals $8.15 billion. For year 4, it's 11.5 billion divides by 1.07 powers 4 equals $7.60 billion. For year 5, it's 12 billion divides by 1.07 powers 5 equals $7.08 billion. Step number 5, estimate terminal value and discount. After those 5 years, the company still makes money. We use a trick to figure out its forever value. Then we shrink that value back to today's terms using the discount rate. Formula for terminal value is final year cash flow multiplies 1 plus perpetual growth rate divides by discount rate minus perpetual growth rate. Now we calculate as terminal value equals 12 billion multiplies 1.02 divides by 0.07 minus 0.02 equals $244 billion. Formula for discounted terminal value is terminal value divides by 1 plus discount rate powers n, where n is the number of periods into the future the terminal value is estimated at. Now it calculates at discounted terminal value equals 244 billion divides by 1.07 powers 5 equals $173 billion. Step number 6, add up the values. We add the present values of the cash flows from the first 5 years, which is 9.35 billion plus 8.73 billion plus 8.15 billion plus 7.60 billion plus 7.08 billion equals $40.91 billion. And calculate the forever value by adding present values and discounted terminal value, which is 40.91 billion plus 173 billion equals $213.91 billion. So now we get the total value of the company in today's dollars. Step number 7, divide by shares outstanding. A company has lots of little pieces, called shares. We divide the total value by the number of shares to find out how much each share is worth. Now Coca-Cola has 4.3 billion shares, so it's calculated as 213.91 billion divides by 4.3 billion shares equals $49.30. Now we have to know if the current stock price is greater than the value calculated, then the stock is overvalued. And if the current stock price is lower than the value calculated, then the stock is undervalued. So compared to Coca-Cola's current stock price of around $60, the stock appears overvalued based on this intrinsic value we calculated. Thanks for watching. Don't forget to like and subscribe. I'll catch you in the next video.